Well, most Asian stocks may be up today, but concerns are growing as to whether the 5-month rally is about to stall. And our first guest today believes we'll see small but frequent corrections going forward. Lorraine Tan is head of Asia Pacific Strategy at Standard & Poor's, and she's with us live today from Singapore. Lorraine, thanks for coming on the program. Let's start off by talking about the broad pullback we saw in the markets yesterday, particularly with China. Are investors simply exhausted with the run we've had this summer?
I do think so. I mean, we've had a very, very strong run through to July. I mean, if you just look at Shanghai index, it was up 79% for the year through July. So it's not surprising to see a bit of a pullback. I mean, China's got its own issues. We did lower our weighting on the China market itself to a neutral position from an overweight recently. And that's got to do with a lot of mopping up that's probably going to be going through the second half of the year. And with the reduction in liquidity, with more IPOs going on, I think some interest will be taken off.
Hey, Lorraine, let's talk about valuations now. Everyone's zeroing in on this. And from your perspective, are the markets simply too expensive?
I think if you take a midterm view, I think markets are still fine where they are. I do expect, you know, we do need to see corporate earnings sort of catch up with the confidence level in the market at the moment. So I think with obviously fourth quarter numbers on a year-on-year basis are probably going to look pretty good because of the low base. That will actually help the confidence factor a little bit more as well. Having said that, in the near term, we don't think there's going to be enough positive news flow to really stop the consolidation that we're expecting over the near term.
And you've predicted quite a lot of range trading. So how do investors navigate this market? You've recommended buying on dips, selling on rallies, or sitting on the fence. Which one of those strategies should investors be taking?
Yeah, I think it's going to be it's been a trader's market. I think that's not going to change for the near term. Having said that, I think it's difficult. It's a difficult thing to do if you're, you know, removed from the market. So we're actually recommending a bit of a hedging sort of a view. Although we're generally long equities, we're advocating that people take an advantage of buying some of the cyclical sectors that have done very well recently, mainly on dips if possible, but otherwise try to pick up some of the defensive laggards as well.
We're going to get into your sector picks in just a moment, but I want to talk about the markets in Shanghai and Hong Kong now. Right. Markets in Shanghai right now down about 0.3%. In Hong Kong, we're seeing the market up about 2%. Now, you noted in a report this week that you still see decent value in the H right. shares. Why do you like them? Talk about the H shares.
Well, on a valuation basis, the majority of H shares are still quite comfortable, given where they were previously as well. If you look at the performance, they've not really outperformed the region in the same way that the A shares have. So they're up about 40% for the year to date. The valuation-wise, you're still looking at about 15 times, which is actually fairly comfortable given the recent historical average for the H shares. Growth-wise, EPS growth, we're looking at about 21 to 22%, so that's quite decent. So I think, and you know, if you compare it to even the Hang Seng Index, they are trading lower than the Hang Seng Index in terms of PE. So we're still seeing a decent value for a number of the H shares.
Let's zero in quickly on the A shares, and as far as they're concerned, what kind of further gains can we expect here?
Well, we've got a year-end target for the Shanghai Composite Index at about 3,300. So it had actually exceeded our year-end target recently, and it's, you know, nice to see it pull back a bit because I think that was overdue. I do feel that at 25 times, the China market has, you know, probably reflected a fair amount of positives in the current levels. So we're only looking about 10 to 15% upside to the end of the year. Having said that, if, you know, given that recent economic data coming out of the States was actually better than expected, we could see another round of re-rating upward in terms of the year-end targets.
Quick question on the economic situation there in China. Investors still digesting the Commerce Ministry's comments saying efforts to boost domestic demand won't help overcome the slump in exports. As you take a macro view on China, is there reason to be concerned about the strength or perhaps fragility of recovery there on the mainland?
Well, I think the fragility that the external sector weakness is probably something that we're seeing globally. So I think if you look at it on a bigger picture basis, the fact that China has been able to to pull up its domestic spending activities has probably really helped it a lot. Obviously, it can't rely on continued stimulus on the domestic front to pull it up. But what we will see is that the continued benefits of the domestic stimulus will probably carry through to 2010. And by then, you should see the external sector start to pick up. At the moment, the external sector is obviously still bottoming out. But I think there are signs that with the recent U.S. data anyway, that should begin to improve towards the end of the year.